So hi, I'm Miles Jennings. I'm head of policy and general counsel at a16z Crypto. I've been here for about 4 years now, and prior to that, I was a partner at Latham and Watkins. Um, so in my role here, I spend a lot of time together with our engineers and our research team, working with a lot of entrepreneurs on how to build their projects. A key part of that is always kind of dealing with tokens. And so for a long time, we've used kind of a taxonomy internally with our portfolio and trying to help them navigate, exactly what it was that they were trying to accomplish with their token. We finally kind of put that out in public a couple of weeks ago, with the taxonomy really trying to focus on both looking at all of this from a legal perspective, from an engineering perspective, and from an economics perspective. With the goal then being that it's kind of consistent with some of the policy work that we've done on kind of defining decentralization, which we've kind of proposed that should be focused on whether or not these systems are controlled, as opposed to the SEC's 2019 framework, which really looked at whether or not entrepreneurs were engaging in ongoing efforts. Moving the kind of decentralization analysis to something that's purely focused on control as opposed to focusing on ongoing efforts makes it a lot easier to categorize tokens, because it gives you a little bit clearer lines as to where a token might derive its value from something that is controlled versus something that is not controlled, like a permissionless autonomous blockchain. So I'll get into it here, and this is all obviously kind of helpful and informative for the market structure piece of the legislation. And while there's not a ton of about stablecoins in here, there is a brief bit. So I'll dive in. Okay, so the first category we have are just security tokens, and this is what Robin was just speaking to. That was the kind of piece in the middle, which is that we do need legislation around digital securities that would enable you to basically take a share of stock and issue it on chain and have that trade permissionlessly on chain. And so these are just traditional forms of securities that are moved on chain. Obviously, their treatment is going to be subject to securities laws. And we're not proposing that they have a kind of different path, but the idea is that through legislation we can kind of come up with a framework that allows these things to trade on chain as opposed to having to trade through intermediaries like brokers and transfer agents. Next category is network tokens. This is the most critical category from our perspective and what we're most focused on investing in. These are speculative assets that are intrinsically linked to and derive their value from the programmatic functioning of a blockchain or smart contract protocol. So think Bitcoin, Ethereum, Solana, Uniswap, even Doge, which started out as a meme coin, is technically a network token because it does have its own network. So I think that the critical thing here, right, is that these things often have embedded utility, but that doesn't necessarily kind of exclude them from securities laws. And the final piece here is that we're really focused on the economic mechanisms that these protocols use, and that's one of the critical components for figuring out, basically whether or not its value is being derived from something that is controlled by humans versus not. So in the case of like Ethereum, right, this comes up with EIP 1559, where every time a transaction happens on Ethereum, a portion of ETH is burned, which results in overall economic value accruing to token holders. So you see that in a lot of layer ones. At application levels, like with respect to Uniswap, it's been a little bit more of a struggle to get that type of economic value accrual mechanism in place. One of the reasons for that is that the SEC kind of targeted that activity as being more indicative, framing it as being more indicative of there being a potential securities transaction. And so that's one of the things that we're hoping that the SEC kind of moves away from now, because ultimately, if these tokens don't have economic value accruing to them, then it's hard to distinguish them from meme coins. And from our perspective, we think that that's one of the reasons that a lot of people have moved towards the meme coin and sector of the industry, because ultimately it's been harder to distinguish value accrual of ordinary tokens from meme coins. All right, so then there's company-backed tokens. The most prominent example of this is FTT. So these are basically speculative assets. They can look like network tokens, right? They can use a blockchain to facilitate payments, but at the end of the day, their value is totally derived from a system that is controlled by a company. So, for instance, in the case of FTT, right, all of the value of that token was derived from FTX operating its exchange. And that was obviously a centralized business that was operating. And what they would do is they would take the profits of kind of operating that exchange and promise to the market that they would then take a portion of those profits, buy back FTT and burn it, right? Thereby kind of closing the economic loop of that system. So it's very critical to be able to distinguish between a network token and a company-backed token, because a company-backed token looks very much like a profits interest in a company. There's no decentralization, so it has all of the trust dependencies that an ordinary security does, right? It just doesn't have a legal relationship embedded in the actual token itself. But again, given that all the trust dependencies are very similar to a security, it makes sense to treat these, similarly to securities law or how we treat securities. Now, a great example of this, right, was when FTX collapsed. Right, the price of FTT basically went to zero. So that is something that we, want to very clearly distinguish with our entrepreneurs, right? And we try to direct them towards building network tokens as opposed to company-backed tokens, which we think are mostly regulatory arbitrage at this point. Now, the key kind of distinguish between a company-backed token and a network token, right? It can be difficult because these things can be very complex and you can have value accruing from multiple sources. But essentially, we look at really three things to distinguish company-backed tokens from network tokens. One is the network open, right? And so that means, can anyone build on top of it? Is it totally permissionless? So in the case of Ethereum, anyone can deploy a smart contract. In the case of Uniswap, anyone can put a front end that accesses the protocol. Do the network effects accrue to the protocol and token holders, right? Or do they accrue to some centralized company? In the case of Ethereum, right, the network effects of the system accrue to ETH token holders. That's the way that the economic model works. In the case of FTX, right, all of the network effects accrued to FTX, right, because if they just shut down their system, the token would go to zero. There was no network there. Right. So as a result of that, the network effects were accruing to FTX, which makes it more like a company-backed token. And then you look at whether or not it's enabled, the token is enabled to basically accrue economic value independent of the DevCo. Again, in the case of Ethereum, that happens naturally by the way that the blockchain functions. In the case of FTT, that did not happen without the FTX role, which again, when FTX collapsed, the price of the token also collapsed. The last are a little bit more straightforward. So arcade tokens, think of these like mileage points or reward points. They're basically currencies within usually within a closed system that an issuer uses to basically control a digital economy. So this could be digital gold in a video game, right? Or it could be loyalty points. One exciting example out there right now is Blackbird's Fly. Blackbird is a network that connects a lot of restaurants. And Fly token is a token that is like a rewards point within that system that enables people to earn those rewards, but then also spend them on meals at the restaurants that participate in the network. These are mostly generally not securities because they are not speculative and people are not investing in them. And so these are really true utility tokens. Collectible tokens, these are most often called NFTs, right? These are assets that kind of derive their value from being a record of ownership of some tangible or intangible good. So think art, music, membership in a club, or some type of game asset. Typically, non-fungible, so they're always called kind of NFTs, and their treatment is still subject to securities laws, as we've seen over the last few years. But we're hoping that the SEC kind of makes some progress in drawing some clear lines for entrepreneurs and creators. And then asset-backed tokens. So these are basically assets that derive their value from a claim on or economic exposure to one or more underlying assets. So this is where you would have stablecoins, right? A stablecoin is essentially just a deposit receipt on an underlying piece of collateral. In the case of USDC, that's treasuries. And so ultimately, right, these tokens, when you're looking at their overall risk profile, you have to look at the risk of the underlying collateral, as well as kind of the issuer of the asset-backed token itself and what they're doing. That also kind of includes liquid staking tokens, as well as derivatives. So this is an area where we've seen quite a bit of activity, but not something that we've seen kind of clear, definitive guidance from the SEC on, and that's another area where we're continuing to push. And then finally, meme coins, which I think one of the frustrating things over the course of the last year has been that a lot of entrepreneurs come to us and will say, "Hey, we want to do a meme coin," and then they'll describe something that is really not a meme coin. And so you see this kind of all of the time, and it's been a fairly difficult narrative over the course of the last year. But inherently, right, there's nothing wrong with meme coins when they're actually truly meme coins, which is that they have no intrinsic utility or value. They're tied to an internet meme, right? Community driven network, right? As opposed to someone launching a meme coin that is tied to a company, right? That kind of breaks the inherent qualities of meme coins that make them not subject to securities laws. As a result of that, right, we also see a lot of kind of market manipulation and fraud in this space, which has generally been, not a positive development over the last year. But hopefully, I think the SEC's recent guidance on this, clearly delineated what meme coins are versus what they are not, and so we're hoping that is going to be helpful. So finally, just a quick summary chart here. Right, I think most of these types of tokens can be offered in securities transactions under Howey. So you do have to kind of look at the nature of the offer. I think company-backed tokens are much more similar to they're basically proxies for securities. So we think that securities laws should delineate between company-backed tokens like FTT versus network tokens like Bitcoin and Ethereum. Failure to distinguish those things really would lead to the ability to securitize any product without being subject to securities laws. So that's not not something that we think would be great. So I think that in market structure legislation, which again was what Robin was talking about as well, that there needs to be a very clear focus on delineating between network tokens and company-backed tokens, so that any legislation that we do pass for digital assets doesn't end up becoming a workaround for for securities laws. Ultimately, right, network tokens can eliminate the trust dependencies that securities are subject to, whereas company-backed tokens can't. So we do think that that's a pretty clear line that needs to be drawn. All right, that's all I got.